What's up, YouTube? Eric here, Mr. Fired Up Wealth. Hope you're doing well. Hope you're hanging in there. I know it's a rough time with the markets right now. We're having a nice little bounce today, but a lot of uncertainty with Russia-Ukraine crisis, with the commodity prices, oil prices. Are we going to go into a recession? All those different things. At the end of the day, if you've got the right time horizon, the right attitude, and if you have knowledge, knowledge is power, and it can make you very, very wealthy. And you should embrace times like this. I'm not saying just go all in, but I'm going to teach you today the 64 most important investing principles that I learned from Peter Lynch, reading his books and just following him over the years. Now, if you don't know Peter Lynch, he's one of the most successful investors of all time. He ran the Magellan Fund, basically took the Magellan Fund from very small to the most popular mutual fund on the planet, doubling the return of the S&P 500 during his 13-year tenure running Fidelity's Magellan Fund. And through just following him over the years, reading the books, I've learned a lot from him. You're going to say, some people are going to say, hold on, Eric, Peter Lynch is not a growth investor, he's a value investor. I understand that. But the principles he teaches, they really relate to any type of investor. And if you follow me closely, I teach balanced and diversified portfolios. And a lot of the Fired Up Wealth methodology, I took basically different backgrounds from other people and learned from other people like a sponge, and made my own journey, my own path. I created my own methodology, and it uses inspiration from people like Peter Lynch. The masterclass goes into this in more detail, explains all the different people that inspired me to basically create the Fired Up Wealth methodology. Today, I'm focusing just on one segment. So these slides are from the masterclass series. I'm going to focus just on a handful of slides that cover the 64 investing principles. Let's get right into it. So over time, stocks have performed better than other asset classes. Stay tuned. I'm going to show you a chart here in a little bit and show you what it looks like if you go into a bear market and what that bull market might look like on the other end. So definitely stay tuned, guys. Tax-deferred accounts. So he teaches about tax-deferred accounts, investing in retirement accounts, because obviously you don't want to pay a ton of taxes. Now, if you're investing for financial independence, you probably don't have much of a choice but to have a taxable brokerage. But it is very important to still have those tax-deferred accounts. And that's something that I really learned from Peter Lynch. The power of compounding, the eighth wonder of the world. Your money is growing over time, and your profits are gaining profits on top of profits. The earlier you start, the younger you start, the easier it is because of the power of compounding. And of course, because of that, time is the most valuable asset you have as an investor. Right now, if you're young and you're in your 20s and 30s and you're looking at your portfolio and you're all worried, use it as a learning experience, but understand that you've got time, which is the most valuable asset you can have as an investor, and you've got plenty of time to make it up. When I started investing, I made mistakes. I was able to learn from my mistakes and turn it around and become financially independent from it. And of course, with this downturn, I've lost some of my net worth, but still doing very, very well. You look at being invested. I've been invested over 20 years, almost 25 years. So I've made a lot of money in the stock market. It's afforded us the ability to buy businesses and do other things with that money as well, not just own stocks. When will you need to use the money? This is something I learned from Peter Lynch, just having the proper time horizons. And we'll talk more about what that means here as we go through. Stocks are volatile. They go up and down, but historically they trend up over time. Of course, you got to pick the quality ones. You don't want to pick ones that are going to go out of business, right? That's the key. But at the same time, we're going to learn from Peter Lynch, you're not going to be right every time. A good stock can take years to pay off. So of course, we want that instant gratification. On Twitter, it's like if you don't buy a stock today on FinTwit, it doesn't go up 5 or 10% tomorrow, then you're a bad investor. Really, that's trading, and it's that endorphin, that adrenaline rush that you get from being right and making money in a short amount of time. And that's unfortunately what most people are chasing, and they're not really investing anymore. Peter Lynch's best stocks took 5 years to unfold. 5 years. And he patiently waited knowing the story was going to unfold. Good stocks and stories need time to grow. So if you're down on a stock and everybody's telling you it's trash, if you have conviction and you understand that story and you think that it just needs time to grow, remember Peter Lynch, one of the most successful investors of our time, even though he was a value investor, you can still use that same approach if you really believe in an idea. Of course, if the company has no profitability, it has no path to profitability, and it's just a garbage company, a garbage stock, it's probably not going to recover. It's probably not going to make you wealthy. But if you're investing in quality companies, even if the valuations are high, understand those growth companies can grow into those valuations with time, and those stories can take time to unfold. So quick intermission here from the slides. I want to show you a history of the US bear and bull market since 1926. So this chart shows historical performance of the S&P 500 index throughout the market, basically from 1926 to March 2017. The average bull market period lasted 8.9 years with a total return of 468%, while the average bear market lasted 1.5 years with an average loss of 41%. 41% loss for a 468% gain. This shows you guys that if you've got patience and you continue to add, this is an opportunity when you have these downturns to buy, to accumulate shares, because look on the other end of this. You know, the Great Depression was awful, 2.8 years with an 83% and a 47% decline. But if you held on to those stocks and you added, of course, some companies go out of business, and that's why it's important to invest in quality and have diversification. But if you invested in good companies, they bounced back and you had an 815% return. Heck, even if you lost everything, if you kept investing while it was down and buying, you're still making a ton of money over that period. Then you have a 6-month period where it's down 21%, a 935% rip after that. Down another 6 months for 22%. 143% gain. I mean, look at this. 845% gain here over 12.9 years, 816% gain over 12.8 years. After the dot-com bubble, we had a rough period, but you still had a 108% return over 5 years. Arguably, a lot of those companies took a long time to recover. And then most recently, after the housing crisis in 2009, you know, we had a downturn of 1.3 years, which was a 50% and a 41%. It was really nasty. But then a 281% rip after that, 8.1 years. So where are we at now? Hard to say. But if you are investing in quality companies and you're continuing to accumulate, you see what happens on the other end of these downturns. And this is where money's made. You don't become wealthy and grow sustainable long-term generational wealth by buying stuff at the top. You buy it down here and you sell it up here. You know, buy low and sell high is what you're looking for. But if you're a long-term investor and you've got a 5 and 10 year horizon, you're just continuing to add the best you can, and you see what happens on the other side, guys. Hope this helps. Use what you know to take advantage of opportunities. The industry you work in, for example, the products you use, like as a consumer, you know what's good. So I used to do this all the time, like Costco. I bought Costco because I went there the first time in 2015 and I absolutely loved it. And I'm like, oh my God, I can buy shares of this company. I want to own a part of this business, you know? And there's a lot of examples like that. You might own stocks because, you know, you really like the product. So invest in what you know, especially the industry you work in, because you have an edge. You know more about that industry. I worked in the software as a service, SaaS, you know, software, enterprise software industry, and 23% of my taxable brokerage portfolio is in SaaS companies, and that's not even including the mega cap tech stocks. That's just the pure play SaaS stocks. You know, almost 25% of my portfolio. But I feel like I have an advantage in that sector because I worked in that sector and I understand it. I feel better than the average person. Take advantage of it. And I learned that from Peter Lynch. Buying stocks in your own field can be a great strategy since you have an edge with information. So this one is huge. Investing is a personal thing. You have to have emotional strength to stomach ups and downs. And I think conviction ties that too, because it's very personal. What you believe in, what you have conviction in, is going to be different than what I believe in and maybe what everybody else believes in. But emotional strength, now we're talking about psychology and discipline, right? Morgan Housel type stuff. This is really important as a long-term investor to stomach those ups and downs. You need patience. Number 14, if you know something that will help a company's earnings, you may be able to take advantage. You might know something that maybe the common public doesn't know, and you could take advantage of that. Research starts with things that you know. Most investors do not have time to understand a ton of companies. You only need to understand a handful of stocks very well. And I agree with that. I mean, I like to invest in a lot of different stocks for other reasons because of the way I structure my portfolio. But you don't have to. Like, there's no wrong answer. You can have 5 stocks or 500 stocks if you want, you know. But there's really no wrong answer. It's, again, individual. Investing is personal. It's individual. Your portfolio should be part of your DNA, basically an extension of who you are and what you believe in, what you have conviction in. And that's going to be different for you versus me versus your neighbor, right? Number 17, and this is huge. Watch for secular growth trends. If you have not subscribed to the channel, do it now. Click the bell to get notifications. Make sure to drop a like and drop a comment. But what I really try to focus on is secular growth trends. And again, people are going to say, but Peter Lynch wasn't a growth investor. He still focused on secular growth trends. And you think of like technology, you can look at stocks within technology that are still part of secular growth trends that could still be considered value type stocks, right? It doesn't have to be all hyper growth when we're talking about building a portfolio. And if you follow the Fire Wealth methodology, you know, I teach ETFs, dividend stocks, growth stocks, spec stocks. It's not just all hyper growth. You need to have that diversification and that balance in your portfolio. And people like Peter Lynch helped me understand that so that I would build those portfolios that way. Trying to time the market or predict the market is almost always a losing game. Now, I see this a lot. People are like, you should have sold in November and then bought it back. It's very hard to do, and it's always easy in hindsight. And sometimes people get lucky. But I know people that have done it and they try doing it again and they lose badly. You know, they're hurt very badly. So it's a losing game. It's just like gambling. Sometimes you gamble and win, but most of the time the house wins. If you're trying to time the market, the odds are against you. And over time, you're eventually going to lose. And you're going to get cocky and you're going to lose big. So you might win big and you're going to lose it all, you know, later kind of a thing. When markets crash, it's almost always a tremendous buying opportunity. We're in that right now. Could it go lower? Yeah. But people will say, well, you know, we're in this everything bubble and everything has to go down 50% more. Like, give me a break. Look at the forward multiple of the S&P 500. Look at historic and where we're at now. It's still running a little bit expensive, but we're at much more reasonable levels. You know, a company like FedEx is back to, you know, 15-year lows when you look at valuation. You know, not stock price, but valuation, you know, what their multiple trades at. And you say like, well, there's risk for it. I understand that, but there's so many different names. You look at it, it's like there are opportunities out there, and your job as a stock picker is to go find those buying opportunities. You need to believe the company will do well over time. If the story changes negatively, it's often time to sell. This is where people make the mistake of, if the stock just goes down, oh, I was wrong, and they sell the stock. You know, is the stock broken or is the company broken? What he's saying here is if the company changes negatively, the story is broken or the company is broken, then you might want to sell it. But be careful. Make sure you understand the difference between a broken company and a broken stock. If the story changes, and now, like say, for example, the company does something really scandalous or they change their management, you know, the story changes where you're like, I no longer have confidence in this company that it'll do well over time. That's when you want to sell. Break stocks into categories and develop stories. Now, I do that from a bucket level. I have dividend stocks, growth stocks, ETF, spec, and then I develop stories to say like, okay, what's the secular growth trend? Okay, cybersecurity. Well, how does that work? How does cybersecurity work? What are the best of breed companies within that? What do chief technology officers, what are they looking for when they're trying to build out a stack? You know, a technology stack, and they're trying to have cybersecurity built around that. What's that look like? Develop that story, figure out the businesses that are needed to create that story, and then those are the stocks you do more research in and eventually probably buy the names that you have most conviction in. You cannot expect all stocks to behave the same. Every stock requires different analysis. So if I'm looking at a cloud SaaS stock, I'm going to value that completely different than if I'm looking at Tractor Supply Company or something like that. Every single stock requires separate analysis. And people try to use like P/E ratio and use it for everything. Doesn't always necessarily work. You know, I see Rule of 40 being misused all the time, where people say, oh, the Rule of 40 for this stock, and it has nothing to do with SaaS. And it's like, you don't use Rule of 40. You know, you look at magic numbers, rules of 40, you look at EV/MTMs. There's a lot of ways to value stock, but every single stock, every sector has a different way to really analyze the sector. And every single stock is going to be analyzed a little bit differently. And that's something I learned from Peter Lynch. Slow growers almost always remain slow growers. So in other words, if the company is not growing now, it's probably not going to grow later. there are some times where the company pivots. Microsoft's a good example where they've done really well over the last, decade plus, but they were stale for a long time. So it doesn't always have to be the case, but most of the time, if the company is a slow grower, they're probably always going to be a slow grower. Fast growers, slow growers, cyclicals, stalwarts, asset plays, and turnaround stories are the 6 stock categories that Peter Lynch leveraged. And this is part of the masterclass as well. You read One Up on Wall Street. It's one of the best books of all time. It's my favorite, probably my favorite, financial book of all time. He talks about fast growers, slow growers, cyclicals, stalwarts, asset plays, and turnaround stories. If you don't know what those are, Google it, look it up. I think it's very helpful. Cyclicals can become turnarounds and usually go back to being cyclicals. Oil was dead in 2020 during the pandemic. Now everybody wants to buy oil. Eventually, it'll be a cycle. It's cyclical, and oil stocks will go back down, and something else will be cyclical again. That's just how a lot of the stocks are that way. You want to look for secular growth trends. Secular growth trends are ones where it's not as cyclical in nature. Cyclical stocks, you can make a lot of money if you buy it on the uptrend of the cycle, like with commodities, but you can get crushed if you buy those stocks at the wrong time. You buy them at the top, just like growth stocks. Growth stocks, you could argue that growth stocks by nature were in an uptrend cycle. And if you bought the top, it kind of got down. But don't confuse the growth stock cycle and actual cyclical. Cyclical stocks are going to be things like, you think metals, materials, oil, the commodities, the stuff we're looking at right now. Wheat's at 10-year highs, palladium, you name it. Everything is jacked up. The reason the market's actually popping a little bit today is a lot of those commodity prices have actually come back a little bit. Smaller companies almost always have more risk reward. You can make a lot more money. A $1 billion market cap, you can make a 10x stock out of that, but it also has more risk of going out of business. He liked to find companies that are growing at 25% or more a year. Now, of course, as a growth investor, you might have different metrics. You might have higher, but 25% or more a year that's still a really good number. Even by growth investing standards, you look at 25% more a year. That's not hyper growth, but those mature companies, those blue chip type companies, you can find the ones that are still growing at 25% a year. Those are the type of deals that he was looking for. Growth companies give you plenty of time. This is really important. So growth companies give you plenty of time. You don't have to get in at the beginning to capture amazing gains. A lot of people think like, oh, well, the stock's already ran 200%. And there's a fine line. There's a fine line between chasing FOMO and buying the top and getting in a story that's got a lot of room left to run. Like NVIDIA, you could have bought NVIDIA, any time over the last, 15 years. And there was periods of ups and downs, but that stock has slowly just crushed it and gone higher and higher and higher. And you could argue that NVIDIA, well, it's already ran so far, or look at like Amazon. It's ran too hard, too fast, too far, and there's no growth, left in it or whatever. There's still plenty of room with those companies. They might not be hyper growth anymore, but you have plenty of time to get in and catch amazing gains still. A lot of people think that you have to get in like day one or you just avoid the stock, and that's a mistake. Growth companies like baseball games have 9 innings. Wait until the second or third inning after they started to prove themselves, but have several innings left. This is something that absolutely just changed my mindset when I learned this. So you don't want to try to get in. A lot of people want to get in like spec stocks and just fill their portfolio with spec stocks and say, these are all going to be huge companies. We're in the first inning. Well, then, half of them don't prove themselves and they fail. What you want to do is find those stocks, have them on a watch list, wait till they get to the second or third inning and prove themselves and capture those last six innings of earnings. That's where you can make a lot of money. And it sounds so simple when you hear it that way, but it makes a lot of sense. It really does. Fast growers get the media attention. Just like now with FinTwit, with whatever, social media, fast growers get the media attention, but slow growers can still be an important part of a balanced portfolio. You can buy, quality companies that are maybe consumer staples or financials or whatever you want that still have some growth and kind of balance that portfolio out so it doesn't have so much beta. When the market goes down 2%, you're down like 5%. Balance it out and get some of those slower growers that create a little stability and balance in the portfolio. Slow to moderate growers have 3 to 15% annual growth. So if you own a stock that has 14% annual growth, it's considered slow to moderate growth. Of course, 3% would be slow in my opinion, but 3 to 15%. You need steady earnings growth. And this is where a lot of these work from home stocks have gotten in trouble. A company like Zoom grew 350% or something, 328%, and then their comp is almost impossible. And then they grow 30% off a 300% plus comp. Well, that's still really good growth, but Wall Street looks at it as, well, that's contraction from 300% growth. You want steady earnings growth. It's better to have steady earnings growth, taking the steps up versus riding the elevator up, because then it creates problems and the stock doesn't perform well. So you want steady earnings growth, basically like a stair, and that every quarter they're just beating and raising. That's what you want. Of course, it's a lot harder said than done to find those companies, right? Companies who raise dividends each year usually means the stock has room for growth, but not always. So if they're raising their dividend, they have confidence in the company. And this is one that's probably debatable. You could say, well, I don't really agree with that, but I think that this is a good one to include. Companies who raise dividends each year usually means their stock has room for growth, but not always. The stock market is forward-looking. Cyclicals can be dangerous if you buy the wrong side of the curve. I mentioned that earlier. You don't want to buy oil at the top. You got to be really careful of those cyclicals. If you buy a cyclical, you're looking for a dramatic turnaround in earnings, but you have to know when to get out and sell. So when you buy cyclicals, they're like really long swing trades. And that's something that he was really good at, riding those trends, buying at the right time on the uptrend and then selling towards the top. He was really good at doing that, which is part of the reason why his returns were so good. Turnarounds are similar, but behave differently than cyclicals. So turnaround stories, usually a new product, new management, cutting costs, something inside the company that sparks the change for it to be a turnaround story. A turnaround story usually takes time, and you would need solid evidence before going in. So like Microsoft in 2012, like, hey, they're going to develop this cloud services offering, and I think the company is going to turn around. That's about when I invested in Microsoft, and it worked out really well for me. Sometimes 2 + 2 = 8. The market often misses value for a period of time. Wall Street can be late on these stocks, and you have to take advantage. So you look at some stocks, and you're like, why is this beat down so much? Why doesn't Wall Street have any appreciation? And then, a couple years later, you give up and you sell the stock. And then a couple years later, you look and it's 3 times more expensive than what you sold it at. And you're like, what the heck? Wall Street can be late sometimes in the stocks. I do think that Wall Street moves faster now than maybe it did in Peter Lynch's time, but it's still a valuable lesson. The price of a stock generally follows the direction of earnings, which is why earnings are so important. When they have an earnings miss, stocks have an earnings miss, the stock sells off. You cannot predict earnings, but you can predict the direction of a company to ride earnings growth and stock appreciation. You cannot predict the future, but you can learn from the past. Turnarounds can be the exception. A PE ratio is simple. If a company's stock is $100 a share and its earning is $10, its PE is 10. Simple, right? That's the number of years a company will need to earn back the amount of your initial investment, assuming no growth. And of course, it's still one of the most popular valuation metrics used. PE historically should be less than growth rate per year. However, new age growth stocks have defied this rule for years. But now we're seeing a lot of that contraction back too. Hidden assets can be an amazing way to profit as an investor. Just because a company, so he talks about on number 46, he talks about, I think, a golf course that had a sand lot or a gravel pit. And basically somebody bought it and then sold the gravel pit. And basically, it worked out to be where they almost got the golf course for next to nothing. And it's been a couple years since I read the book. I need to read it again, but it was something like that. And that's where the hidden assets can be an amazing way to profit as an investor if you understand what you're buying. Maybe the current owner doesn't understand what he or she has, and you can take advantage of that as an investor. Just because a company had great earnings in the past does not mean it'll do so in the future. You need reasons. What is the outlook? So past performance does not guarantee future results. Dividends come from profits. So you got to have profits to have dividends. Number 49, maybe controversial, but homes can be an important way to build wealth. He talks about having the biggest house you can afford and using it as a tax shelter. And this is before the deductions were increased and things like that. But I read that book and I was like, you know what? That makes a lot of sense. And so we actually, went a little bigger in the house. We're very frugal and everything else, but we went a little bigger on our first house than we probably should have. But it actually helped us a lot. It helped us kind of jumpstart our wealth at a young age by getting into a house and getting some nice returns off the house. I personally don't consider, when I do my net worth, I don't use my house as an asset, but it is an asset, right? If you own a $500,000 house and you've got no mortgage, it's an asset, right? But I never use that in calculations just because I like to keep it separate. And this goes back to personal preference, going back to rich dad, poor dad type stuff as well. Yield equals annual return percentage per year. Okay. Fast growers usually reinvest into the business and do not pay dividends. Therefore, the highest reward usually has no or minimal dividend. NVIDIA pays a dividend, but it's next to nothing. DGIF stocks. The key here for me is DGIF. You want a company that's paying a little bit of dividend, reinvest those dividends, have that compound, but you don't want the dividend to be, 3%, 4% a year or a high dividend payout ratio. You want to have the company to have some earnings left over so the business has money to invest in future growth, because that's what it's all about as an investor. You want future growth. High yield is usually not a good thing. So if you've got an 8% yielder, you might want that as a retired person for an income stock, but they've got no money to expand the business for growth. If the company cuts dividends, it'll make the stock plummet. So what that's saying there is, if it's an 8% dividend stock, the only reason anybody owns it is for the income, not for the growth of the company. And if they cut their dividend, like AT&T, I think recently did, the stock gets hammered. So that you have to be really careful with doing that. And generally, if you're going to do that as an income investor, you want lots of different stocks. Your goal is to feel as confident as possible with the company story. This is conviction, having conviction in the company story. Do your own homework, do your own research. That's going to give you that conviction. Be careful of market saturation. The stock will slow or decrease as growth becomes limited. The skill is to minimize risk and, of course, maximize reward. Lynch wants to be right. This is really important. He wants to be right 6 out of 10 times. You will not be right every time, but you can still easily beat the market if you're right 6 out of 10 times. And as a growth investor, this is really powerful. He used this approach with value investing. You think of growth investing, if you're getting 10x stocks and you're right even 5 out of 10 times, you're going to crush the market. But 6 out of 10 times is what he uses. And this is really important because people have this overconfidence effect. So you think of Morgan Housel, you think of overconfidence effect, psychology, thinking that you can beat everybody else. You're smarter than everybody else and you have the confidence you can do it. So in your brain, you assume you should be right every single time. But the reality is you won't be right every single time, and you don't have to be right every single time to make a lot of money in the market. And once you can learn that and accept that, it makes it a lot easier because you're going to make mistakes. And instead of dwelling on the mistakes and saying, oh, I shoulda, woulda, coulda done something else, and basically, moping around about it and focused on the past, you're like, hey, it happens. It's part of investing. You saw the stock and you move on if you were wrong. And that's really what the best investors really do, is they master that psychology and that discipline. If you believe strongly in a stock long term, you do not have to worry too much about timing the entries. I think that's something that all of us can work on. I try to perfectly time my DCAs. Like I look at a technical analysis, I look at a chart, look at the technical analysis and say, oh, this stock's going to bounce right off this S1 or this S2. And it goes a little bit lower. At the end of the day, again, you don't have to be perfect. If you believe strongly in the stock long term, it doesn't matter if you get it 2 or 3% lower. Does it add up over time? Yeah. The more you're right over the course of 20 years, it can make a big impact on wealth. So I'm not saying it's not important at all, but don't beat yourself up if you buy a stock and the market's going down and it goes a little bit lower. Just do your best to DCA in. You might get a full position and be down 10%, but so what? If you believe in it long term, you're going to get that money back and then some. Take advantage of market declines by purchasing high growth stocks. So what this is saying is really important right now. So I see a lot of people, here's the mistake that they make. So they don't have any DGIF or ETFs. And so they have all growth, and growth gets hammered. So their portfolio is down 50, 60%. And they're like, oh my God, I have to change my portfolio. They start dumping growth stocks at the lows. They start buying, oil stocks and dividend stocks and bank stocks, when those are still at decent levels. And what they should be doing is the opposite. They should be selling, some of their oil stocks, and they should be buying those high growth stocks. The high growth stocks get beat down the hardest, and they have the most upside recovery. And if you use that approach, Peter Lynch was good at this. He was able to purchase those highest growth stocks when they were down the most and maximize his return on investment. So in this type of market, you see bad advice all the time, like you shouldn't buy high growth stocks, stick to these quality names. This is actually the opposite right here. He's saying purchase high growth stocks on market declines because they get hit harder than everything else. Focus on the company. What's it making? Who's the competition? Why is your pick better than the competitor? Is there a moat? Keep up to date with the fundamental stories. Listen to earnings calls, things like that. Realize again that stories can take time. Stock picking is not gambling, but it's also not for everyone. I have friends that gamble in Vegas and they always tell me, oh, I did a parlay on this and it's no different than you buying growth stocks. It's different. I mean, if you want to believe that, fine, but stock picking is not gambling. It's not gambling. A gamble, if you're wrong, it goes to, it's zero. You either win the bet or you lose the bet. With stock picking, you might be wrong in the short term, but long term, that stock can rise from the ashes and make you a lot of money. So it's very, very different. If you're investing in quality companies, the stock might be broken sometimes, but if the business isn't, eventually the stock will recover. Do not be intimidated. Anyone can do well. This is something he says. It just rings in my head when I hear it. Do not be intimidated. Anyone can do well. Patience and a little research can empower you to beat the market. Basically saying, everybody can do it. Retail investors like you and me, we can beat the market with a little bit of patience and discipline. So I consider Peter Lynch the GOAT. He's the greatest of all time. And 63 and 64, you can outperform with many stocks. So even though he said you don't need a lot of stocks, he also says you can perform a lot of stocks. It doesn't matter. It's up to you. The Magellan Fund had tons of stocks, and we still able to outperform. You hear it all the time, like, well, why don't you just buy an ETF? Well, because if you buy the right stocks, if you're a good stock picker, you can outperform the ETF immensely. And he proved with the Magellan Fund, there was times he had hundreds of stocks and still was able to beat the S&P 500 by double. And so you can outperform with many stocks. And this is partially why I have as many stocks as I do. Modern portfolio theory, or MPT, also kind of ties into this. You do what's best for you. If you want 5 stocks, great. If you want 100 stocks, great. Right now, I'm carrying around 75 to 80 stocks, which is the lowest I've had in years. If you watch some of my older videos from 2019, I had up to 130, 140 stocks in my individual account. What I'm doing right now is I'm focusing on highest concentration with highest conviction, where I've done a lot of homework and research. Since I started being an analyst full time, I have more conviction in certain names, and I'm putting more money into those specific names. Plus, I'm also not dividend investing anymore. I'm going for growth. And so I can bore you with the details on that, but maybe for another time. So limited downside versus unlimited upside. If you invest $1,000 in a stock, the most you can lose is $1,000, but the upside is unlimited. That $1,000 investment could be $100,000 profit if you buy the right stock and you have some patience. So this is what I've learned from Peter Lynch. I hope this is helpful, guys. If you like this video, drop me a like, drop me a comment. Don't forget to subscribe, click that bell to get notifications. I appreciate your time and attention. Hope you have a great rest of your day. Take care.